Thank you. First of all, I want to just thank all my clients that's come online. Thank you very much. And from my side, thank you for Phillip and everyone else that's helping us. For those that don't know, Eugene he assists us from boutique investment partners with all the fund managing for our clients, and they also give us a lot of information. And I think that's awesome to have that kind of assistance and that kind of information that comes through is actually incredible. It helps us quite a lot here at Nesher Investments and Nesher Management. So that's absolutely awesome. And if I may say, I think today's the first time I can say my son-in-law is also online with my daughter. So they just got married. So welcome to Megan and to James. Just thought I'll just say that. It's awesome to have him online as well. And everyone else. If there's any questions, please, you can put it in the chat box, or you can mail me afterwards and I can direct the questions to Phillip or wherever you intend it to be, and we take it from there. But over to you, Eugene, and thank you very much for setting this up for us.
Hercules, thank you very much for that, and thank you for allowing us to speak to your clients. It's always a great privilege to do that. And, you know, maybe from our side, we know things are volatile, markets are uncertain, but there's always light at the end of the tunnel, and nothing ever stays bad forever. We've asked Portfolio Metrics to join us as the guest speakers this afternoon. And joining us online is Phillip Bradford, who is the head of the fixed income team, and Liam Dawson, who's also at Portfolio Metrics and who runs the equity portfolios. Maybe just a little bit more background. Portfolio Metrics is one of the top boutique managers and also DFMs or discretionary fund managers in South Africa. They also have a global operation and a global office. So they're very much in the markets, managing funds in different asset classes. Phillip Bradford came across from Sasfin. He was head of investments or chief investment officer at Sasfin, where he ran a multiple of portfolios or fund mandates very successfully with numerous accolades and awards. Phillip, I'm not going to mention all the awards because it will take more than half an hour, but Phillip Bradford, most certainly one of the top or highly rated fund managers in South Africa. For our clients out there, for our audience out there, what are boutique managers? Well, boutique managers are, simply put, it is talented managers that normally leaves big corporates or bigger groups, start their own asset management companies where they've got more maneuverability, more ownership of the business, and they definitely tend to do better than most of your large managers, not because they're necessarily smarter. Some of them are definitely smarter, but for simple reasons, they are more nimble and they can move quicker than some of these extraordinary large companies. Phillip, I'm not going to waste any more time. You got the brief. You've got a couple of slides that you prepared for us. I'm going to leave you to it. For our audience out there, if you do have questions, please put it in the chat room. Unfortunately, we're going to keep everybody muted for the session. But if you have questions, put it in the chat room. We'll try to deal with that as best possible. Hercules, you're more than welcome to direct questions from your side directly. I will keep an eye on the chat room and we can try to deal with some of the questions afterwards. Otherwise, you can email it through to Hercules and we'll try to get some answers on those questions for you and circulate it after the presentation. Liam, Phillip, Alan from Portfolio Metrics, again from our side, thank you so much for your time this afternoon, and the floor is yours.
Thank you, Eugene and Hercules, and welcome everyone this afternoon. I'm going to be talking about bonds and income type assets predominantly in the context of everything else that's available. And I think bonds in particular are very much a misunderstood asset class. I think most people understand the stock market. It's the sexy side of the market. But bonds are actually a boring investment that have actually been giving exciting returns, and I'd lead up to still continue to do that. So it's an area of the market that we focus on a lot. We invest across global multi-assets, everything from local to global stock markets and property and bonds, etc. But we find that bonds in particular are almost like the foundation of a portfolio. They're the spine of a portfolio, and they really provide this very strong base load type return, if I can use the nuclear analogy from a power sense. Just very briefly, I'll just go through this very quickly. So given the time, so Eugene's already mentioned our team. We've got a very strong investment team split between London and South Africa. Here are the pictures of the team. And then more importantly, here's myself, Liam, who's on the call as well, and Ricardo, who managed this specific portfolio. And Ricardo and I have been working together now for just over 7 years in this specific area. And a lot of the track record goes back to that. What we're talking about here in terms of the dynamic income fund is we're trying to provide a high level of income for investors with a focus on capital preservation. So we're focusing on lower risk type investments, but as you'll see over time, it's actually provided actually over the last 7 years much better returns in the stock market, mainly because of the types of yields that are available in South Africa in this market. And we aim to generate a better return possible than the bond market, but we also try and do it with much less risk. So we look for a much lower volatility, a much smoother ride in the portfolio. And really, there's a whole huge range of income investments in South Africa. The All Bond Index only has 20 bonds in it, but there's nearly 2,000 bonds on the JSE, far more than there are stocks. And these are just instruments that people don't understand as well, but I'll come back to exactly what that is in a moment. And also the market that we invest into, it is not a market that the average investor can just go and buy and invest into these themselves. So we deal a lot with the banks, with a lot of the other companies that issue bonds, which is essentially debt, and a lot of the investments that we get involved in are just not available to the man on the street. So no matter how much money you've got, really, unless you're plugged into the institutional market and you know how the market works, you don't really get access. So what's quite nice through a fund like this is you get access to investments that you can't go and get hold of yourselves. More importantly, you're getting access to the kinds of yields that even large corporations can't get if they invest in instruments directly. And importantly, we don't invest in equity, so there's no stock market risk. We don't invest in property, and we don't try and hedge out any currency risk. So we're not trying to profit from the rand weakening or strengthening. We're looking to provide the highest rand return possible. Over time, it's been very successful. This is the strategy, the combined strategy that we've been managing, which has been the top performing strategy across all the peers in our category. And there's been quite a significant difference there, but we'll go into that a little bit more later. First of all, what is a bond? So I always like to say a bond is a fixed deposit. It really is a loan where you lend your money to someone else. If you lend your money to Standard Bank, or you take out a fixed deposit or you put it in the bank, you're actually lending money to the bank itself. And that's probably the simplest example of it. And we know of a bond being a home loan. So a loan is a bond where if you take out the loan, if the bank lends you money, they're entering into a bond with you. The first bond that's been discovered was in Mesopotamia in 2400 BC, which was essentially a contract of lending money to do with a wheat transactions. And a lot of your agricultural type futures and derivatives and all these other things go back many, many thousands of years before the stock market ever came along. And that's your first instance of it. The more recent bonds that became known were bonds like the war bonds, US Liberty bonds here, which I'm showing you examples of, which were used to raise money for wars. The first bonds that were used to raise money for wars were actually the British that raised money to fight against the French, against Napoleon back in the day. So a bond is really a way of raising money. Bonds tend to pay coupons and interest, as I'll show in a moment, and there's some other examples here. These were the baby bonds, which became popular in the Great Depression under Roosevelt in the States, who issued bonds to try and help the average person save, essentially for their children. And then you get a lot of infrastructure type bonds for railroad projects, etc. in the past. And I've actually got some certificates on the wall behind me, which are bond and equity type certificates. Just very briefly, here's one of those Liberty bonds that I mentioned that was used to raise money for World War I. And when the US entered the war, and you can see here, this was a bond that was offering 4.25% interest. It was going to be paid every 6 months over the 2-year period. You were going to get your 4.25 broken up into 2 payments over the year. And these were the actual coupons. When we talk about a bond with a coupon, there was a coupon that you pulled off the bottom. like you did even in share certificates in the old days, and that's really the basis of it. Essentially, the bond is a loan. As I've mentioned already, they get issued by governments or companies to raise money. It's a fixed interest instrument. In other words, you know what your cash flow is going to be. You know what your coupon is going to be. It's either a fixed rate or it can be linked to the prevailing interest rate. So it can go up and down with the repo rates or the prevailing rates in the market. Really, you get your coupons. Like with a fixed deposit, get paid every year, every 3 months, every 6 months, depending on how it's structured. And then at the end of the period, like the example here, you get your capital back as well. So essentially, a bond is a capital guaranteed instrument. The guarantee is as good as the guarantor. And we tend to focus on banks, insurance companies, and then some of the government type bonds as well. And really, this is the end of the day. If the someone who gives you the guarantee can't pay you back, or can't even service that coupon, that would be considered a default. It doesn't necessarily mean you lose all your money. It just means that they might struggle to repay those coupons. So we obviously are very cautious to avoid any company that is going to go bankrupt that can't pay you back. That's why we focus on the banks and the secure institutions. And as I mentioned, there's lots of different types of bonds. So bonds go up and down on a daily value, on a daily basis, simply because if you lock in a fixed rate for 5 years, let's say at 10%, just a simple number, and if interest rates go up tomorrow to 11%, over that 5-year period, you're essentially getting a lower interest rate than you could have. So if you're going to value that instrument, it would move up and down. So the things that influence the prices of bonds are your falling so it tends to go up in value when inflation is falling or interest rates are falling, and when also there's greater demand for the instruments directly. So in other words, when if you fix in a rate nice and high and the interest rates start falling and inflation starts falling, the value of the bond would move upwards. And similarly, if inflation is going up or interest rates are going up, normally your bond values would change. Importantly, your fixed rates get factored in way in advance, as I'll show you in a moment. But at the end of the day, you get your money back. So you're entered into a contract to get a certain rate of interest, and at the end of the period, you're still going to get that money back, regardless of what happens to the value in the interim. You get your money back at the end of the day. Now, at the moment, these rates are actually slightly out of date. This was a couple of weeks ago. We started to see some of the rates go up, but these were some of the rates we were looking at the time. We were taking from some of the major banks. So if we went to one of the banks with 100 million rand or more, we were getting call rates of around 4.6. We were getting fixed deposits of 3 months of about 4.9%, 6 months of around 5.9%, and then a floating rate bond, and this would have been from like a Standard Bank or an Investec or one of the major banks, we were getting 6.4%. In other words, and that rate would then go up and down as interest rates move. So currently, as if the Reserve Bank raises interest rates this week, that rate will start to move up with that, and vice versa. Then when we looked at the fixed rates that are available from some of the government bonds and some of the others, you'll notice that if you were prepared to fix your rates, and this has actually moved up to about 9% in the last few days, you can actually lock away and earn a return that is significantly higher than the return on a bond or an instrument that is linked to the repo rate currently. So there's nearly a 3% differential currently, 2.5% to 3% that we're finding between if you're prepared to lock away and lock in longer dated rates. Now that is, of course, because the market factors in future rate hikes very, very quickly. And if you're prepared to lock your money away for 8.5 years, 10 years, or even out to 26 years, today, actually, we can lock in rates if we're prepared to lock it away for 26 years at nearly 12%. Now, importantly, these are very liquid instruments. They're the most liquid. They're significantly more liquid than anything on the stock market. So if we do lock in rates, we can always sell that instrument very, very quickly as well. So it's basically a portfolio of almost fixed deposits and the likes, but it's very, very liquid. So investors that come into the funds are able to benefit from some of the portfolio earning rates of around 12% and even higher, but still have their daily liquidities across the portfolio. So then South Africa is a unique market as well. Given our high interest rates, our interest rates are incredibly attractive to foreigners. And what we found over time is that even despite the volatility we've seen in South Africa, the economic problems we've seen, and even the currency depreciation, we've actually found that bonds in South Africa have tended to give you a very good return. And most of you probably wouldn't believe me here, given what's been happening in recent times. But if you took over the last 20 years, if you took the first 10 years, so from 2001 to 2011, South African equities significantly outperformed global equities. And this is including the rand depreciation over the period, by the way. So South African equities did nearly 300% for that first period, or just over. Global equities actually did nothing. For a 10-year period, they gave us no real return. And then you'll see that bonds here gave you a return over that period of around 177%. Over the next 10 years, we've seen now to the end of last year, we know equity valuations have fallen again. But global equities gave you a huge return over that period, and South African bonds continue to give you a decent return. Importantly, if we looked over the total 20-year period, including the rand appreciation over 20 years, you'll notice that South African bonds and global equities actually gave you pretty much the same return, a very similar return. And strangely enough, South African equities, despite all the noise we've had over the last few years, it's been a much better place over the last 20 years to keep your money in South Africa than to take it offshore, simply because the interest and the returns you've been getting have been more than compensating you for any kind of devaluation of the rand. And you can see it here on a cumulative basis. You'll see that only in recent years, in the dark blue line, you have the global stock markets actually caught up to some of the lower risk investments like the bonds. So the equities are like the hare and the bonds are like the tortoise. And they tend to plod along and give you the returns that you've agreed to receive in a bond space. But you'll see equities have obviously been very, very volatile, but tend over time to give you a good return as well. So South Africa is an interesting market. And I often say is that South African yields and interest rates and bonds are a bit like living in South Africa. We know that there's more volatility and there's more uncertainty, but we know that, like with living in South Africa, our quality of life is significantly better. And we know if we go offshore, we're going to get a much lower return. So if we move to London or you move somewhere else, you know that for the money that you spend, you're not going to have the same quality of life. And what we're seeing right now, despite what's going on in the world, South Africa is actually in a relatively good space if you compare it to a lot of the other emerging markets and developed markets. So from an economic perspective, our current account is positive at the moment. If you look at the last time interest rates were going out in the grayed out area here, which was what we called the taper tantrum at the time, you'll notice that South Africa and most of the other emerging markets, including the ruble here, which is Russia, we're in a much weaker position from a currency and a trade perspective, and they're in a much stronger position now. So this gives you an idea of why Putin felt so emboldened to actually invade the Ukraine. The last time he invaded the Ukraine and took over the Crimea, Russia was actually in a very difficult place and the oil price was at very low levels. Similarly, if we look at South African inflation, oops, sorry, let me go back one. If you look at South African inflation here, you'll notice that even though inflation is reaching higher levels in South Africa, it's still significantly lower than the US, the EU, and then other countries like Brazil, which are our major peers or countries that we compare to. So despite actually South African, I filled up my car today and it was a bit of a shock in terms of how much petrol cost. But at the end of the day, our inflation is actually a lot lower than we've experienced as South Africans for over most of our lifetimes. And for our inflation to be lower than other countries is very, very important from a relative valuation perspective, because foreign investors are very concerned about the real yield. So what's the return they can get after inflation in South Africa? And you'll notice on the green area here that South African yields, in other words, the interest rates you're getting in South Africa after inflation, are pretty much higher than any of the other major investment destinations out there. Some of them are still getting negative rates like you're seeing in the US and the UK. In other words, inflation is much higher than the interest rates available. And this is the 10-year rate in South Africa, your 10-year fixed deposit. If we look forward as well, and we look at if we add on another 10 years worth of locking your money away a little bit longer, and again, I'll just remind you the investments, we might be fixing in a rate, but we can sell and trade out of those instruments at any given minute. But you can see now on when we take the 20-year rate in South Africa minus the cash rate, that we've all of a sudden stick out head and shoulders above most of the other destinations, some of which are much riskier than us, some of which are much less risky than us. But on a relative basis, the yields in South Africa are still very attractive. And when we look at the gap between the cash rates in black here and the rate that we're getting out of our average rate out of our bonds at the moment, it's one of the highest it's ever been. I grew up in this interest rates environment in the early 2000s when I started working in the bond market, and then later through to 2007, 2008, where if you locked your money away for 10 years, you were getting a 4% less, 5% less than cash. And then only recently, and particularly since Nenegate and then later since Corona crash, are we starting to get really compensated for fixing buying some fixed rate instruments in the portfolio. And here we can see again a similar story where, as I've mentioned, if you took your 20-year rate and you minus the cash rate, when I was involved in the bond market here, you were getting negative returns. You weren't getting paid to lock away your interest rates and to buy fixed rate instruments, when right now it is pretty much the highest it's ever been for us as investors. So there's this unique opportunity at the moment where long-term interest rate hikes have been more than factored into the South African market, and we're getting paid, we're getting compensated to actually be conservative and fix the payments that we're getting. It's a very fluid and dynamic market, so we do change and actively manage it a lot, but we're getting really well compensated for doing that. So how do we translate this into returns? We can show over time how by being actually more conservative and managing the risk, we've been able to outperform the bond market, which is the red or purple area here, as well as the peers in the space. So significantly ahead of what others have been doing, and I think mainly because we are just doing things quite differently. We know that we're able to be very flexible and look for different opportunities that are available in the market. And when it's not time to fix your rates and lock in nice high fixed rates, if there aren't good rates available, we move more into cash type investments. And when the opportunity is better, like it is right now, we actually manage that exposure and bring in those higher yields. Here you can see on a risk adjusted basis. So what we're showing here is the returns up the left hand side and the risk on the bottom. And really what you want to be here is you want to be somewhere in the top left. So you want to get more return with less risk. And that's typically what we've been doing over time. We've seen a lot of volatility in the bond market in the last while, and bonds trade and sell off all the time. They're much less risky investments, as I've mentioned, than equities, but there are capital volatilities, and you can see the red line here is the all bond index. And yes, over time it grows steadily, but on a month-to-month basis, there are sell-offs. And what we look to do is we look to wait and be cautious, and then pick up on the opportunities and lock in rates at nice high levels when they sell off. So the rates we're seeing at the moment, near 12%, are the highest. I mean, they're over 1.5, nearly 2% higher than we were getting before the Ukraine invasion. A lot of it has been driven by things that have got nothing to do with South Africa. South Africa's in a much better spot than we're finding most other emerging markets and developed markets. We'd rather be in South Africa right now than in Europe, to be honest, given everything that's going on in that part of the world and the inflation they're dealing with. So we've been able to be quite conservative. As the bonds have sold off a lot in the last month or so, we've been able to keep the capital relatively stable. There are some ups and downs, but we find for investors that have got the 12-month horizon or even a little bit shorter than that, the interest that we're receiving is very, very high and gives them a nice return. And you can see this is just over the last year and a half in the bars over here, how that return has come through. What we've then seen here, this is our current positioning of the fund. We've actually got the yield of the fund at the moment to just over 10.5%. So we've been waiting for the outlook for interest rates going up to get factored into the nice bond yields. And we've now just been steadily adding more and more nice fixed rate instruments into the portfolio, locking in yields at these nice high levels. And once we've locked in those yields, those are the yields that the investors tend to receive going forward. I often use the analogy of a fruit tree. Really, that's a more similar investment. That's what this is. This is not about how tall can the tree grow. It's how much fruit can you get from the tree. And currently, we're getting a yield of over 10%, which means that over the next 12 months or so, we should be getting a 10 to 11% yield. As interest rates go up more, the yield will carry on going up a little bit with that as well. And really, that's really where the returns are going to come from into the future. And with interest rates where they are and with stock markets where they are, that is a very, very attractive return. It's a significantly greater return than you get than inflation, even with inflation at these elevated levels. And we really believe that by being cautious, it's paid off very nicely for investors as well. So while the bond market, you can go and get a slightly higher yield, you actually take a lot more capital risk by doing that as well. So in summary, the current environment is relatively good for South Africa compared to developed market and emerging market peers. I haven't spent too much time on the global and local inflation outlook, but I've got some slides on that which I can jump to in a moment. But really, South Africa is more attractive. The analogy I like to give, I was giving a few years ago, if you went into the 3 or 4 months before the Rugby World Cup in 2019, South Africa were serious outsiders, and you could get 10-to-1 odds on South Africa winning the World Cup. In hindsight, that would have been a very good bet to take. And the point is really similar like that with our bonds and our interest rates, is you're getting very, very well compensated for retaining that money, for investors that want an income, that want a conservative type return, but still need a decent return. To be honest, a return more similar to what you would expect from stock markets. Bonds in South Africa are providing those returns without the currency volatility, without the capital volatility. As I mentioned, they're offering nice returns above inflation as well. The global environment remains uncertain, so it's not an environment to just be brave and take on too much risk. It's an environment with rising global inflation and interest rates. The outlook is actually now that a lot of the inflation and interest rates are actually potentially going to start moving downwards again into the future. The outlook for rising of interest rates may still go up for a bit, but we're starting to see very early signs of inflation turning to the downside. Things like wheat, as an example, the wheat price is lower now than it was before the Ukraine invasion. The oil price is only marginally above where it was before the Ukraine invasion. And really, these high prices have put pressure on economies around the world. And as the economies start to struggle, that will start to take a lot of the pressure off inflation and off central banks to raise interest rates too aggressively. However, we still got these geopolitical risks which can influence and keep prices higher than expected. But as I say, we worry quite a bit about the growth from here on out. So we're a lot more worried about growth slowing down than we are worried about inflation shooting to the upside from here. The bad news gets factored in very, very quickly. And we're more worried about commodity prices actually falling more than expected, because that can negatively influence South Africa, and particularly the rand. But importantly, these things are largely factored in. We also worried a bit about what's going on in South Africa from a fiscal perspective, in other words, our spending, as well as the economic and political risks. So we're going to have some excitement between now and the ANC elective conference in the end of the year, as we see in the politics playing out, and as well as things like load shedding or just outside impacts on our economy that are not welcome. So while our yields are very, very attractive, it's not the time to be too aggressive and to invest to lock in yields too high. We know that the yields we're getting in the portfolio at the moment are still really good returns, and they're the kind of returns that most investors would expect more from riskier type investments. So we're quite conservatively positioned. We're actually benefiting if rates go up more in South Africa, but also we've taken advantage of areas where getting higher rates than are likely to happen. So in other words, we see interest rates going up a bit more in South Africa, but the rates that we are getting in by fixing our rates are more than compensating for any rate hikes that are likely to happen. So really, yeah, we're dynamically managing this. As the name of the fund said, I suppose we manage these risks for our investors. Most of our investors in this fund are actually professional investors themselves that look to us to manage these risks for them in this bond and fixed income space. It's a very different market. It's a market that a lot of people don't understand as well. We see it as that core part of the portfolio for any investor. You know, whether you're 18 or 80, I think, and you're living in South Africa and you've got assets here, you can still have your global exposure through equities and a lot of the other asset classes. But we find that these high yields and returns we can get in South Africa on the lower end of the spectrum, the lower end of the risk spectrum, are just very, very attractive for investors. So that is the end at this stage. I do have some other slides on inflation and the like. So if you'd like me to jump into that, Hercules, I can. We do have some extras here, so I can. Let me touch on that quickly because I think we've got a few minutes, Eugene.
That will be awesome.
Yeah, no, you're more than welcome.
So you know, inflation is a funny thing, and everyone notices it because it's backward looking. And we know right now that inflation has jumped quite a lot in South Africa, but it's not nearly as high as what's been experienced in the past. What we're seeing, particularly if you look at some of the developed markets, is inflation is back at areas that was last around 40 years ago. But this has been driven by two things. The one is the supply issues, which were a problem from the COVID lockdowns. The second thing is the United States printed $7 trillion worth of money and gave most of it to people. So just to cut it simply, they had excess money, they couldn't spend it. And now when they want to spend it, the things aren't available. So this has created, even if you take the Ukraine out of the equation, we were seeing this supply chain and demand bottleneck. Now, a lot of that comes out of the system quite quickly, and high prices are the cure for high prices. The higher prices are, the more it hurts demand, and things start to slow down again on the other side. So we're starting to see early indications of as an example, core CPI in America, which is your inflation that strips out fuel and food and some of the volatile items, has actually been coming down for the last 3 months. And we will start to see that eventually in South Africa as well. So we see inflation going up a little bit from here, but starting to come down again, not getting near the 8% level, into the mid-7s, and then starting to come back again. And all your central banks will be looking forward at that. So they're very worried at the moment about inflation. They need to be seen to be doing something about inflation. But at the end of the day, if they raise interest rates too much, it will actually hurt their economy so much that inflation will actually come down quite aggressively. This is just a slide, more of a scary slide, showing how higher, if you look at the red areas of where inflation is at higher levels all around the world. But as I've mentioned already, these things are starting to come out of the system already. And the blue line here shows how interest rates have actually moved up in America. Remember, in America, when they take out a home loan, they fix their rate for 30 years. So what you'll see now is where you were borrowing close to the 1.9% area earlier on in the year, you're now borrowing at 3% plus in the States. So if someone sells their house, they might have been locked in at 1% from a year or two ago. They're now going to be borrowing at 4.5%. So that's going to hurt a lot of the consumers, a lot of the housing market in America, as well as other areas around the world. So in other words, interest rates have already gone up. When you're locking away your home loan at 30 years at a 30-year rate, the market factored in rate hikes, more rate hikes than are expected. And if anything, your longer-term US inflation should get down to that 3% and closer to that 2% level again, as would be expected off these very high levels at the moment. It's just the base effects of prices start to come down. And then really, this is South Africa as well. You know, we've grown up with much, much higher inflation than what we're dealing with at the moment. And one of the major reasons inflation is actually struggling in South Africa is because demand is weak. It's because the economy is weak. So it takes two parts of inflation. You need people to have money to cause prices to go up. So while we've got some prices that are going up which are out of our control, a lot of your demand-driven inflation is really coming out of is not really there in the system too much. So while we might have inflation go up a bit, we're expecting it, as I've said already, for it to start slowing down later on in the year. So inflation is very important. We expect the Reserve Bank to sort of stamp their foot down and make sure that inflation expectations in particular and people's perception of inflation doesn't get too high. But we're likely to see the pressure start coming off now in the second half of the year on a lot of these central banks. So the next month or two might be a bit more volatile still, but we're likely to see this start settling down. And the dollar has been so strong. The dollar is at its highest levels it's pretty much ever been. It's definitely the highest level it's ever been against the pound. It's the highest it's been for over 20 years against the euro, and it really is hurting a lot of other things when the dollar is strong as well. Simply because America's in a much stronger economic situation than most other countries around the world, and therefore their interest rates are higher. So it's just keeping their currency strong. So we see a lot of those pressures starting to come out of the system. So there, I think, Hercules, I don't know if there are any questions. I'll be very happy to take them. I've jumped through a lot of topics. And I'll be very happy, as I say, to take any questions if anyone has some.
Philip, I don't see any questions from the audience, Hercules, unless you received something on your side. But I do have a question. And maybe just for the audience, we recently included the Portfolio Metrics Dynamic Income Fund in the Nesher income portfolio, as well as the opportunity portfolio. So the opportunity portfolio, we took some risk off the table and gave it to Portfolio Metrics. And Philip, I think very important what you mentioned before, it's very difficult for individual managers to manage a fixed income environment. It's something that you need to keep your eye on the ball almost on a daily basis. And you're doing a great job of that. The past 6 months has been rough, though, even for fixed income funds. And I think, we understand a lot of it has to do with interest rates that increased, and I think increased a lot faster than one would have expected at the beginning of the year. We saw the Fed jumping up 75 basis points. South Africa followed. It did hurt the bond market in the short term. My question rather is, can we expect much more of the same, looking forward over the next 12 to 18 months?
Yes, so I think an important thing again is to understand, what we're investing in here. So, when you're investing in the stock markets, I showed you how the American stock market did naught for the first 10 years of this millennium. Yes. When you're buying the shares of a company, you're getting a share of the profits and some of the cash flows, but that's very uncertain, and you're driven by the valuation of the equity. Here, this is, as I gave the analogy of the fruit of the tree. So while the capital might move around a bit from a month-to-month basis, the return's really going to come out of the cash flows. So if we're buying effectively debt instruments that we've got a contractual cash flow that's coming through over time, that's what the return's going to be. The volatility of that capital, can be, I suppose, a bit distressing if you're looking at the value on a day-to-day basis. But we actually had many more volatile periods actually over the last little while, and I suppose people are focusing on it particularly right now. As I just share this slide again, and you can see last year, we had the bond market fell by nearly 7%. It fell by nearly 7% again earlier on this year. And it tends to recover quite quickly, simply because at the end of the day, what drives the value of these kind of investments is the interest that we receive. And it accrues and it builds up, and then we pay it out every 3 months. So the capital value tends to wobble around, and we're in the middle of a stage at the moment where we've had the capital drop on the fund. And I'm just looking over the last year and a half. In this period in March last year, the capital fell by about 1.8% from a top to a bottom period. But the month ended positive. What we had that 3 or 4 times last year, and then more importantly in March this year, there was a huge drop just after the Ukraine invasion. And what we're looking to do as investors is not panic in those environments, but rather actually to take advantage of it. So our default position is to be very conservative. And as you can see here, yes, there's been a dip from a value that was up over just before this last little panic in the markets a bit. But we've been nicely positioned while the bond market's fallen, sort of 8-9%. We've actually been able to be relatively stable, and then just use the extra cash that we've got to say, thank you very much. We'll just lock in yields at these higher levels. So it is emotional, I suppose, in some respects, but the nature of the investments we're dealing here at the end of the day are like I say, they're like fruit trees. It's about the fruit we're going to get. And I'm pretty confident, if we are from a yield on the fund at the moment, so all the instruments we've got together are yielding around 10.5%. As interest rates go up, they yield a little bit more. I'm pretty confident that we're going to provide a return that's in that sort of range, somewhere between a 9 and 11% over the next 12 months, simply because that is the cash flow we'll be receiving. So I think if we look at these things on a 12-month basis, we're very, very confident we'll do much better than a cash type return. On a short-term basis, someone panics somewhere else around the world, and if anything, it gives us an opportunity. We've seen the foreigners running away in the last week or two. Some bank in America has said, hang on, sell all your emerging market investments, and then we're saying thank you very much. We'll lock in our rates at 11, 12%. So I think it's really about understanding the markets, understanding that this is not the kind of investment that shows negative returns over 12-month and longer periods. And in fact, if we look, what we've lived through was significantly worse than what's happening right now. If we look over the last 7 years in terms of managing this portfolio, if we combine the two funds together, Nenegate was an absolute disaster. We survived that very comfortably. If we look at the Corona crash, the Corona crash that we saw in the South African markets was 3 times worse than the financial crisis, and everything came through that smoothly. So we can see that in the returns over time. Yes, there's a bit of a dip from a short period of time, but then the cash flows just come through, and you start getting, that's really what dominates the return over time. So it's not the kind of investment that you sit and you look and you go, oh, there's 2 or 3 years in a row of negative returns. It's just you have a month or so when things tend to dip. I think things might get a little bit worse there before they get better at the moment. But if anything, again, that creates more of an opportunity for us, because we know we're dealing with conservative type investments here.
And I mean, like you showed before as well, I mean, the yields are getting exactly that fruit you're talking about, extremely attractive at the moment. So we probably in for, like I said, a little bit more volatility, but looking through it over the next 12 to 18 months, those yields still amazingly attractive, far better than what you get in cash or money in the bank. I don't have any more questions. Hercules, I don't know if you have any questions from your clients or from your side.
No, I just want to extend anyone that's listening or watching this, please send me an email or WhatsApp if you've got some questions you don't want to ask it on this panel. You're really welcome. Phillip, it was an awesome presentation. I actually loved it. I've just seen, we came from a very strong 2021. Our fund's done extremely well over that period. And then you had the inflation in January. You had the Ukraine war a month later. And I think inflation's been the biggest from worldwide at this stage. And what I found is that I found it very optimistic or great. It makes me optimistic, the fact that you said there is signs that inflation is stabilizing. So that's awesome, because that's good news to hear. I think the other thing I would like to hear is that China stops their lockdowns now and they open their economies, because that will also help us with the supply chain problems we got, I'm sure. So we're very, very excited. I think I hope we can end this year much better than we started. That is the aim, and we're hoping for that. But thank you very much for you, and then Eugene, for you organizing everything, everyone on that took their time to listen to us. I'm going to make this link available as well. If I may just say, I will, on the groups, we've already got a next speaker in a month's time. They're going to talk a bit about offshore versus local. That's a question I get every day again. So I'll discuss that with Eugene as well, and we take it from there. But thank you very, very much for everyone that took their time to listen to this presentation. And Phillip, once again, to you and your team, thank you so much.
Thank you. It's a pleasure, and thanks for inviting us. I hope you enjoyed it.
We really did. Thank you so much. Thank you, everyone.
Thanks, team. Phillip, Alan, Liam, thank you very much.
And
cheers. Thanks so much.
Thanks, guys. And for all the clients, have a wonderful weekend. And we're here if you need us. Please just shout, WhatsApp, or email us, call us. we're here and we'll help you through with everything you need. Thank you very much. Goodbye, everyone.
Thank you. Bye.
Bye.